Okay, sounds good. Well, welcome, Megan and Marie. Thank you for taking some time to join us. We're excited to have an opportunity to speak with you. My name's Kate Wentroble. I'm actually neighbors of Cancer Bridges. So my office is the branch in the Strip District location right on Smallman across from the original Primanti's, which is where I'll be having lunch at today. And I want to just share a little bit about myself. I've been with Huntington for a little over 5 years. I've been in banking for about 15 years. I swear that's a true statistic. But I'll kick it over to you, Chuck, for a little personal intro before we dive in.
Yes. Hello, everybody. Thank you guys for joining. I did see the comment. We will make sure anybody that wanted to see the first one of the series, we'll get that emailed out throughout the day. If there are comments and you guys do put anything in the chat, I'll make sure that I can bring it up through our presentation. My name's Chuck Spacuzza. I'm a branch manager over on the other side of town in the South Hills area in Glassport. I've been managing different banks and with Huntington for 12 years, but total managing banks for 22 years now. I just had to have a number that was higher than Kate, so it made me look better here today. But we're happy to be doing this. And as stuff comes up, if there's individual, you can one-off. You'll have information at the end of this that you'll be able to get for me and for Kate. And then anytime we're talking about stuff, if there are links, we will always drop them into the chat for you so that if there's links to other sites or anything that helps you with anything, feel free to always speak up and let us know or shoot some comments in and we'll be happily to address them while we're talking. Off to you, Kate.
Thanks, perfect. So if you did miss the one that we did last month, I actually took just a few snips from it. A couple of slides are from that content. This content, we do trim these down. This is right from the FDIC website. It's called the FDIC Money Smart Guide. It's Chuck and I both work obviously for Huntington. It's just brought to you by Huntington, but it's the Money Smart content from the FDIC. I'm gonna think this is gonna just actually take about a half an hour. I just share that early because if you do have questions or you really want to talk about something specific, we're going to very likely have some time at the end of this PowerPoint for that. So no worries on that. But I think we can go ahead and just dive on in. So really, we're only covering 2 sections today. And the first section is all around income. And the goal with this next handful of slides is to understand your income. And the first step is really the first step in using it so that we can make sure that we're, meeting your needs. So we're going to start by covering types of income. And so, of course, there's earned income. That's obviously from working your job. And then there can be income from assets or from investments, depending on what stage of life you're in. Income from assets would typically be real estate investments. So maybe you owned a home and then bought a new home and then turned that first home into a rental property for you. I see a lot of folks these days doing the Airbnb thing. So when someone is traveling, maybe they're going to the beach, they rent out their home for a week. See a lot of people taking advantage of that. And all of that becomes other, interesting ways to create income or assets. As you get older and maybe you're in that retirement side, you've got Social Security income, annuity income, and then natural draws that might be required or some that you just take in order to make you whole because that was a part of your plan. There's public benefits or entitlements that pay money, other benefits or other entitlements. And then I just love this last one, just other income. Because you never know, other income. I was trying to think of some examples for us. I thought of, spousal support, child support, and I thought a little bit about the situation that you guys are in. And I do know, some secondary insurance plans do pay monthly premiums out to folks that are struggling or going through cancer treatment. So that could be potentially an income that you could see during this difficult time. So we're going to look at gross and net income. So gross is really just the total income before you deduct anything. And then net income is really the actual number you're going to see, right? That's your direct deposit. That's what you actually get to take home. That's what you get to spend. That's what you can rely on. I don't personally even like to look at my gross income. My husband looks, he gets ticked off because this much goes to taxes. And, even I don't even like to see what I'm paying for insurance or any of it. I just stick to the facts. This is how much money I have to spend. All right, so ways to receive income. I mean, I would tell you, obviously, the majority of folks right now are earning their income through direct deposit. I think it's something like 93% that's known income is through direct deposit. Other forms of income is cash. Obviously, some people do still get a paper check or have a payroll card. That payroll card's probably a little more common than you think. And then electronic benefits transfer. I actually entered banking in 2008. So I told you, right, 15 years ago, way back then when folks were coming into the bank, we had paper checks still. In banking, we used to get couriers that would come and pick up teller work 2 times in a day. So like a midday pickup around 1, and then someone would come and pick up work at the end of the day. And that would be physical checks that they would take off, and do what they needed to do. I'm not even really sure. But those are physical checks. And nowadays, it's so much of it's direct deposit. They don't even use that courier system anymore. Anything to add to that, Chuck? Because you are older than me, which you've highlighted with your 20 years. So if you have anything to add. Okay. Well,
I'm sorry. There you go. It was my keyboard wasn't letting me unmute. Something that's a little different, depending on where you get your incomes, is the direct deposit aspect. Something that Huntington has done, which has evolved throughout these years. And with 20-some years, you used to only get your deposits on your payday, or sometimes even on your payday, but not until after 12 or after 3 before it would show in your accounts. Huntington does what's called early pay. Once you've received direct deposits for so long, up to 2 days early, your direct deposit will already show. Many people that have disability and Social Security and the consistent income, if we receive the notice from Social Security on Wednesday on the 28th and your money's due on the 30th of the month, on the 28th, we normally have that money into your account, which helps stop some of those other ways that we talked about on our last one, which was using a payday loan or having to get money a couple days before your money hit if you only get your money monthly. So it's just something to keep in mind that if you don't get direct deposit, it's something to consider, because we have that now, and I'd say, and times are changing, you're going to see that more and more through different finance industries of having stuff like that rewards you for getting the direct deposit.
Yeah, thank you, Chuck. I also had a note in here I forgot to mention. One really big impact to this was actually COVID. So, pre-COVID, I'd say we still had a fair amount of clients that did come into the banks. But now, I mean, most branches, their transaction counts are nearly in half from pre-COVID numbers. So that's just another thing that impacts it. But of course, this is just ways to receive paid your income. So then there's just understanding the pay statement. So if you want to look, right, of course, you're going to have your personal information, the cycle in which your pay period is, which isn't necessarily the date you're actually getting paid, right? They're usually paying in arrears. Your gross pay minus those deductions, the total amount that's going to end up coming to you, and then any contributions that your employer is making to anything else that you might have, like a 401k or an HSA. So what kind of deductions are out there? Of course, there's some required deductions like paying into Social Security and Medicare, income tax like federal, state, local, and then the elective deductions that you'll have like insurance premium, union dues, retirement account contributions. Some companies will allow you the ability to make charitable contributions right directly from your paycheck, which is a tax benefit. And you can also do, even some secondary insurance will allow you to, if your organization that you work for, or how you're getting paid rather, if they don't offer a secondary insurance, and the biggest secondary insurance would just be AFLAC, so an additional insurance upon what you normally or already have through your employer. Sometimes what they can do, because insurance should be pre-tax, they can actually come and work with your employer and take it right out as well. That helps you with managing that sort of end net number, right? We don't want to rely on money that we already know is earmarked for something else. A good exercise that I just wanted to mention, and this is something I do in my personal finances, sort of under the headline more of that first PowerPoint we delivered, which is managing debt. I do an exercise where I actually include monthly subscriptions, because I think it seems like, oh, well, Netflix is only $10.99, not a big deal. But if I look all in, between Netflix, things I pay for through Apple, Music, which is Spotify, and then there's Chewy, and then I get my hair done every 6 weeks. There's this automation to some of the spending that occurs within our life. And I highly encourage, even after that net number, so let's just say your take-home pay is $1,000, think of the things that you spend no matter what in any given month. I am in the Strip District, and so there's a portion of my income that goes to pay to park. I cross my fingers for free parking, but it just doesn't always happen. So if I got to pay to park, I just adjust about $50 a month for that. So something to think about. That way you can really get an idea of, like, actually, this is how much money I have to spend on leisurely spend. This goes over income tax withholdings. That's why I try to make jokes, because we're not really talking necessarily about the most exciting things, income tax withholdings. So this just goes over, Internal Revenue Service Form W-4. So, it goes up additional withholdings, which is going to lower your take-home pay. If we reduce your withholdings, then it's a higher take-home pay. You don't want to have too much or too little withheld. So that's really the ability to get a tax refund, right? So when you increase your withholdings or your dependents, you're going to have a lower take-home pay. I'll say that if you're in a job where you get a lot of bonuses, those are taxed a little bit differently, because whenever you get that large bonus, it looks like you make that every single week. And so that might bump you up into a higher tax bracket just for that one pay period, and it's taxed heavier. And so people that have a bonus structure sometimes will mess with those numbers a little bit to try to, get more of their actual bonus the day, when they're actually getting paid for it. This goes over, more than one job or a paid hobby. You can get paid in different ways. Of course, we're all probably familiar with getting paid utilizing a W-2. But if you were somebody that had a regular job, but on the weekends did some landscaping for some folks, or even worked for a landscaper, he might give you a 1099, because that's what form you would get if you were a subcontractor. We, of course, recommend tracking your income. You want to think of it as regular income, unpredictable income, and that would be that bonus structure, which is built into a lot of folks' income structures. Seasonal income. Business owners are more impacted by seasonal income than, I'd say, the everyday person. And then one-time income. We talked about this last month as well. One-time income would be your tax refund, right? We know that money's going to come in, and we earmark it in December around the holidays that we're going to need it. And we just know that money's coming in. So that's one example of one-time income. So again, just the key takeaway on this is just trying to understand, right? It's really not about that higher level, what your salary is, what your hourly rate is. You want to stay focused and driven on how much do I actually get to see or use? What's that take-home amount? And then my recommendation, this is a personal note, is to really think about your end-all be-all, what's actually left. Think of some of those more nominal expenses, as simple as Netflix or Hulu or whatever. All right, before we go into section 2, any questions out there regarding income that you'd want to put in the chat, or is there anything in the chat, Chuck, that I might have missed? I can pull it up now. Oh, right. Yep. A lot of folks have disability income as well. Yep. And that would be, generally, that would be direct deposit that would come in on a monthly scale. And a one-time income could be from disability. We see this a lot. Somebody who had applied for disability either didn't get it when they should have or is delayed. So you might get an influx, one-time income from disability, then your monthly starts to take place. All right, we'll go ahead and hop on into our expenses. And the goal here, right, understand your expenses. That way you will help you decide how to save, how to share, and how to spend your income. And we'll dive into really what that means. So I love this. What do people do with their money? It's like, well, that's a long list. But we try to make it simple, right? We're either saving it for something in the future, and many people, and I would echo this. I have a goal to save my money to be able to give my money to my children, some amount. I certainly didn't have that growing up, and I want to be able to do that. That's a financial goal for me, maybe an aspiration. And that would go into sharing it. So I want to save it so that I can share it. And then spending it, the easiest of the three. All right, so ways to think about expenses. You know, and this part, when we talked about managing debt, and a couple of my next slides are going to go over some of that. We talk about the emotional part of managing expenses and managing that debt, that end number that you feel like you owe. And so I like this slide for everyone because it breaks it down into needs and wants and obligations. And that just helps us sort of alleviate any emotional attachments we have to what we have going on in our finances. So needs, right? Things that you absolutely must have and you can't live without. Food, shelter, a vehicle likely. Wants, these are just things that we desire, right? Things that we can technically live without, but we probably don't want to have to. Netflix on that list again. And then obligations. So this is going to be any debts that we already owe. Some things to think about when you're trying to minimize your expenses is, could you find less expensive ways to meet your needs? I don't know about you, Giant Eagle, crazy prices, right? So it's like I try to buy in bulk when I can. Sam's Club offer, and that's a good. I think we have a deck that actually suggests buying at a wholesaler because of the price discounts. And here in the Strip District, we have some direct consumer wholesalers. Is there a way to use less money, right? So maybe I'm on a kick right now. My husband used to not drink coffee, so I would go to Dunkin' every morning. I cannot believe the savings of just making my coffee at home. It's $3 a day, so it's $15 a week. And that's $60 a month. And that's, multiply that by 12, which that's a math I'm not that good at. And then, of course, negotiate lower payments for any obligations. So what that's indicating is if you owe money, and in this case, we'll say maybe you owe money to a creditor. That creditor bought that debt at a price. So maybe the debt originated with Citibank and it was $2,000. Well, that $2,000 isn't made up of $2,000 of purchases. That $2,000 is made up of interest. When you're making those monthly payments, so little of what you're sending them is actually going to actually paying off a credit card. And so Citi will be in a position where they're like, actually, if you give us $800, we're, as an example, we'll mark this paid in full and get rid of this debt. You can negotiate lower payments for obligations. It can be hard on the direct to a credit card side to get to the right person, but you can do that. So just a couple of examples, right? Negotiate lower payments for obligations. And this is one of the slides I added from our conversation, just because I wasn't sure, are we going to have a lot of folks that joined last time, or is it going to be completely new folks? And we chose these in a way where they do build off of each other, but I thought this really is a good one for us to kind of come back to. If you were on last month, it might be repetitive, but it's a good center for us. So people get into debt for many reasons, right? We've got the needs, the wants, and that adds to it. But purchase of assets, that indicates things that we might need, like a home or a car. But that asset, most people buy their first home through a bank, i.e. we have debt. Right away, we start with debt. Paying bills, or we might have debt as a result of not paying those bills. For the purposes of our conversation today, of course, I added medical bills because that's something that's on all of your minds. Cover unexpected expenses or emergencies, and then buy something that you want or possibly something you need. So that just kind of creates that cycle. All right, tracking expenses. We consider at Huntington tracking expenses, or I should say I consider tracking expenses a really important part of understanding where your money's going. I am sure that you've had that moment where you look at a credit card bill or you look at your debit card account and you're like, where did all my money go? Or even when I think of times I've gone shopping and I'm like, oh my gosh, it's $100. I thought I just needed like African garlic bologna, but here I am. It just adds up, and when it's $7.28, you might as well call it $10 because that's going to be the impact. Tracking your expenses helps you find that extra $25 that maybe you really didn't need to spend, though it might have felt like you did. It helps you uncover places that you could make a change if you're in a position where you need to make a change. Ultimately, it can help you spend less money.
I think important part about tracking your expenses is if you do use online banking, whether it's Huntington or any other place, see if they have a way of tracking your expenses also. It's surprising for me. We have online banking and we use it for me and my wife. And when we're tracking expenses and I start seeing a month that I spent $400 at restaurants, and I'm like, whoa, where did I spend $400? Why did I spend that much? And I didn't spend as much at a grocery store. So it's good that helps you track the expenses of where you're using everything. If you do start using some online tools, if your bank offers them, or again, if you ever need that, you come in and check out and we can show you how to use our expense tracker.
Yeah, that's such a great call out because we call that service the hub, but we've won a lot of awards for it. So it's a great call out because it's a tool naturally integrated, sort of doing the work for you. Okay, so managing your expenses, what can it really help with? In this case, we're talking, what does it help you avoid? Well, it helps you avoid late fees. The Excel spreadsheet that I use shows me the due date, but it also, my spreadsheet shows me the pay in which I want to pay that bill. So I only get paid twice a month and my bills don't align with my paycheck. And so I track it in such a way where I know I'm paying some things almost 2 weeks in advance, just because that's what makes sense for me and my family. Helps you avoid getting interest charged to you on any unpaid balances by staying on the up and ups. Obviously, it's going to help you with negative credit report entries, loss of services, and additional charges associated with those loss of services. So loss of services would be, excuse me, maybe you forgot or didn't pay a water bill. There's a fee to turn your water bill back on. And we want to avoid any of that fee income for any within banking, within some of the services that are out there like electrical, gas, water, and then of course ways to pay bills. So you can still pay usually in person. I can tell you it's rare, but you might still pay in person. Some people do. You can pay by mail. We do not recommend mailing cash. And you can pay what is common electronically. Most banks offer this service. And every time I show someone this, they're always surprised, even my young folks. When you go in to pay a bill through your online banking service, it'll say add a bill. You can add a bill or add a person. So generally speaking, you could set up in there that you want to pay anybody that, even if they don't take ACH payments or you don't know, you can just mail them a check right from your online banking. Funds come out right away and it just gets literally mailed to them. That's a recommendation to do it that way, because when we mail a check, from our online banking, it's a little bit safer, right? It doesn't look like a bill. And that really is a little fraud prevention piece.
Another nice part about online banking with us and with some other entities is when you mail that out and do it through the online, it comes out immediately out of your account. So when you're mailing checks out in the US mail, you may have 3 days or 5 days or 2 weeks before that check. So you're constantly looking at your account to see what's processed and what hasn't. So when you use online bill payment or stuff through the bank services, most of the time, the minute you hit send, it comes out of your account. So then you're not counting it in your balances. So it helps you keep more of an accurate balance throughout the month.
Yeah, you know what you've got to work with. That's a great call out. And I know it does that, Chuck, but I've never thought of that as honestly a feature. And it really is. When you're thinking about being in that paycheck to paycheck, you want it out. Don't pretend like I have $40 more than I have, I just want to know it's gone and taken care of. What a great call out. So this section is really all around just making sure that we understand, how to break this down. And I think part of what I liked about it is just that emotional side of what we owe, what we need, what we have, can we save? These are just some of the things that a lot of folks are feeling out there. So hopefully you feel like you can get a good grasp on how to understand your expenses. Before I dive into these next 3 slides, and these 3 do touch on our last PowerPoint. Any questions? I don't see anything in the chat. I think we should be good to go. Awesome. So of course, we know that debt can affect your financial situation. Ultimately, this is where you need to use future income, money you don't yet have, to pay your debts. And this is where a cycle can begin to occur. Chuck mentioned going to one of those pay advance places. They take so much of your earned income. It drives me crazy. But some people go there because they don't have a bank, they don't qualify for it, they think they don't qualify to have a bank, or they just don't know what their options are, right? Or they need their check, they need money now, they're trying to figure something out. So, but it's very expensive. Other places where that kind of comes up, or where we see that a lot, like Rent-A-Center, that furniture store where you're kind of renting your furniture, you end up paying 3, 4, 5 times what the actual cost of that furniture is. If you are ever able to protect your credit, as long as you can protect your credit, you'll always be open to services and benefits like, 0% for 5 years on some purchases, right? Those are ways to inexpensively finance furniture, and get what you very well might need. You might need a new couch, right? That's just another way. So needing to use future income to pay your debts. Generally pay interest and sometimes fees on your debt until paid. So that's how credit card debt becomes a real problem. We think it's just a $500 purchase or something. I'm just going to do this. And then it's just so hard to pay it back. And then, it may impact how soon you can achieve your goals. And then you get into sort of a perpetual cycle of just feeling like you deserve it, so maybe you've been trying to pay back that original 500 and then you spend 300 because you deserve it, and you do. And then it just, or credit card debt gets racked up because there's a medical bill that has to get paid so you continue to get service. And continue to get the treatment that you need. You have to stay current, right? And you're balancing all these concerns. So you're swiping a card to pay for groceries with no real plan on how you're going to pay for that. So when that debt does accrue, how do you? I went the wrong way. How do you pay it back? Well, there's 2 methods to paying it back. The first is the snowball method, and the snowball method is there's an advantage to this, and it's more of an emotional advantage because you feel You see and observe progress faster. And when you feel successful, I always relate to like weight loss, just because I had a baby about a year ago and I'm still on my journey. But you just want to get on the scale and see a little twinkle of a less of less 0.1 I would take at times, and so I'm sure we can all relate to something like that, right? So it's emotionally motivating. The disadvantage is technically this method does take a little bit longer of time, or you end up paying more money. So what you would do to utilize the snowball method, and you would do this with debt that has interest associated with it. I say that because medical debt does not usually have interest associated with it. So you'll list your debt's lowest balance to the highest balance. So that would be, a $500 credit card, a $750 credit card, and then a $1,000 credit card bill. And you're going to make payments to the first debt on the list, which is that $500 card. The minimum payment for most credit cards is 1 to 5% of the balance. So in this case, we're just going to say it's $15. So you're going to pay $15 on all 3 cards, because that'll end up being your minimum. And then any extra money you're going to put towards that $500 card. In this scenario, it doesn't matter if that $500 card has the best interest rate associated with it. That's not the point. We're putting all the extra money, birthday money, Christmas money, income tax money, towards the 500, because we want the win. And once that $500 card gets paid off, we're going to shift that minimum monthly payment that we typically were placing there, plus any extra that we have, onto that $750 payment. And then we do the exact same thing to the 1,000. Again, when that 500's gone, you're celebrating, you're motivated to tackle that 750, and then likewise with the thousands.
Well,
Go ahead.
before you flip over there, as she's explaining these, whether you bank with Huntington or don't bank with Huntington, every single branch has somebody that can sit down and help you look at what you have currently debt and the best ways to consolidate or get rid of the debt. So don't hesitate as you're doing this. Sometimes these numbers will get all messy for you, but we do have the debt consolidation. We have a specialist, at least one or if not more specialists in the branch that could help do that. But from January till May, the beginning of May, the United States has went up 17% in credit card debt. We are now at $986 billion in credit card debt for people in the United States. So if you feel we haven't seen it, or you feel that it's too much for you, I can tell you that we are seeing it every single day with every person that walks in. So don't ever hesitate. Even if you don't use Huntington, hopefully your bank has those type of services also. But I can promise you that whether you bank with us or not, we will work with you at Huntington to help you figure out a plan on how to be able to do these 2 different methods that Kate's talking about here to help you get rid of some of this.
Yeah, what a great call out. Very true. That's just who we are. We're here to help. Truthfully, we are. And that's probably a statistic. I think it's a good one, because if you are in a situation where debts feel like they're racking up, or they are racking up, that statistic simply says you are not alone, right? That's just the place in which many people are. And I know, and I'm sure I know why you have that statistic handy, because that was something they shared with us at our meeting the other day, Chuck. But I can remember learning that the number one reason why folks don't end up going to their financial institution is just they're not comfortable talking about it, right? It's like, well, not to go back to weight loss, but it's like that time where you just didn't feel like weighing yourself because you had the steak dinner or something, or the big burger the night before. It's like, no, thanks. I don't want to look at it. And this is just a good time to say, we really are here for you. And we really do see a lot of people in similar situations. And our only goal is to make a plan. Figure out how we can tackle it, and then maybe add just this tiny bit of accountability, because once you say it out loud to somebody, anyone, you feel like, man, I said I was going to do that. So it makes you do it just a little bit more. Okay, so my next slide isn't the correct slide, so I'm going to just discuss this one because I'm familiar. So there's two methods. We reviewed snowball method. The other method is the method where it's called high debt first method. And it's truthfully, you're listing your debts based on cost, with the exception of mortgage or long-term debts. This is typically best with credit card debts. Unless you only have so much time left on a car. So you're going to list your most expensive debt first, and then your least expensive debt. So a credit card at 12% interest is probably at the bottom, and the credit card at 22% is at the top. The advantage is this is the most cost-effective way to do it, where you're paying minimum payments to everybody, but all your extra money is going to go to that credit card with the highest interest rate. This saves the most money. This is where the bank does not make as much money as they could because you're focused on highest debt first. The disadvantage is that top debt might be, $2,500, and it might take you a really long time to feel that win. And so I always give the disclosure I did last month, and I will again. Think about which one will be most effective. I know there's the advantage and the disadvantage, but the bottom line is what's going to actually work for you. You know what you're motivated by. Think about that and execute the plan that might work. And that, again, that's called the high debt first method. Okay, so the next step is to take action. What do you need to do? What do you need to understand? How will you go about it? And then, of course, we always encourage you to share your plans with someone. It can be if you have a great relationship at your financial institution, see them, talk to them, tell them, like, this is what's on your mind. And if you don't, or you're not sure and you want to talk with Chuck or myself, that's what we're here for. And we're happy to do it. It makes us feel good about what we're doing every single day. So this is me and Chuck, the branches that we're located with, and you're welcome to write down our phone numbers or our email addresses. And then I'm gonna actually, Chuck, I'm not sure if you can grab this note in this slide. There's a game that you can play at home. I didn't think it was fun enough necessarily to do on the call, but if you really want to dive into income and expenses, it offers some levity and joy, but it is still FDIC.gov a game from the FDIC. So just giving that little disclosure for you guys. And I want to remind you that the next module we're going to be doing is next month, and it's credit reports and identity theft. I think this one's a pretty full presentation. Participants are going to be able to understand credit reports and how the information on credit reports can affect many areas of your life, including income and expenses, as well as debt management. It's going to also help you identify risks to your assets, identify ways to reduce risks to assets, and then we're going to actually talk a little bit about popular identity theft scams and themes. And that's a really important part of what we discuss. I think that because Pittsburgh's the best city to live in all of the land, we think that it's not going to happen here or it wouldn't, and it does, because it happens in my four walls probably once a month, and we stop it because we're good at our jobs, but it does happen, unfortunately. So that's what's coming down the pike. This is me and Chuck. I'm going to pause. It's 12:42. Open up to whatever questions you might have.